Hey guys, welcome back to 90 Seconds with Chris. Today we're going to talk about liabilities. What is a liability? The quickest financial answer to this question is a liability is a current or future sacrifice made as a result of past transactions. Simply put, a liability is anything that's going to take money out your pocket at some time in the future. Liabilities, along with assets and equity, are three pillars that hold the financial or accounting world together. Let's refer back to my bakery example where $10,000 was needed for startup costs. We raised this money by me putting down $2,000 of my personal savings, $4,000 by selling 4 shares to investors at $1,000 each, and the other $4,000 by selling 4 bond notes at $1,000 face value each, 10% interest rate, and a 10-year maturity date. In this case, my liabilities are the $4,000 I would have paid to investors each year during the 10-year span, $400 each year for 10 years, and the $4,000 face value I'll pay at the end of the 10-year period when the bond is matured. Similar to assets, liability can be divided into short-term liabilities and long-term liabilities. In this example, our short-term liabilities is the interest I'm going to pay yearly, which is $400 I pay to the 4 bondholders each year. And the long-term liability is the $4,000 I'm going to end up paying at the end of the 10-year span when the bond finally matures. Once all the liabilities are settled and the bondholders have been paid, whatever is left off from the assets is considered to be equity. This is money the stockholders can claim and do whatever with as they please.